Good afternoon to those joining us from other time zone and good morning. Welcome to the 2025 Capstone Conference hosted by UC San Diego Ready School of Management and the Master of Professional Accountancy program. I'm Professor Menes Itingekum, joined by my colleague Jim Dioit, Executive Director of the MPAc program. We're also joined by our exceptional TA Stacy Kang and Sieda Ula, whose leadership and support have been instrumental throughout this Capstone experience. Today, you're going to hear boardroom-ready insights from a remarkable group of graduate students, the product of rigorous research and focused preparation. The team is investing in the future, building resilient and sustainable growth, highlighting how boards navigate strategy, oversight, and innovation in an increasingly complex world. Student panels are tackling topics around AI and M&A, ESG assurance, blockchain governance, audit, ethics, and more, all grounded in SEC and PCOB guidance, with real-world takeaways for boardroom and leadership teams. We're very grateful to our key supporters and partners, including Apple, PwC, Deloitte, EY, KPMG, Moss Adams, RSM and BDO, and many more, whose partnership has powered this program and inspire the next generation of professionals. Close your tabs, put on your best headphones, and join us in celebrating learning, leadership, and the future of the profession. Welcome to the 2025 Capstone. Let's begin. Today, the session will be focused on accounting for intellectual property in the streaming media industry. If we look at recent market reports, one of the reports from Deloitte is highlighting how streaming platforms today are facing billions in quarterly write-downs tied to IP impairment, raising serious questions about content valuation practices, capitalization policies, and investor transparency. The panel of this conversation is going to explore the strategic and financial implications of intellectual property in the streaming sectors. The team is going to explain relevant accounting standards, highlight issues with internally developed versus acquired content, examine impairment triggers, and offer board-level guidance on oversight, valuation, and ethical disclosure. Case studies including Netflix, Disney Plus, and Amazon will be covered. I'm very delighted to welcome Shalini to our virtual stage at the Ready School of Management. Shalini will now, and the team will now lead us through this important discussion. Shalini, thank you so much. The stage is yours.
Thank you, Manas. Good afternoon, everyone, and welcome to our capstone presentation. I am pleased to introduce our session titled Content as Capital, Accounting and Oversight of Intellectual Property in the Streaming Industry. Today, we'll explore how intellectual property has transformed from supporting content to becoming the fundamental capital asset that drives valuation, strategic decision-making, and financial reporting in the streaming media sector. Our presentation follows a structured approach to examine this critical topic. We'll begin with an introduction establishing why intellectual property oversight matters now more than ever, define our framework for understanding intellectual property as capital, examine the key legal and accounting standards governing this space, analyze implications for organizational leadership and boards, review real-world applications through case examples, and conclude with actionable recommendations and best practices. Now, before we dive into our analysis, let me introduce Team 10. Our diverse panel brings together extensive accounting expertise, international perspectives, and hands-on experience across auditing, tax, and corporate accounting. Each member contributes specialized knowledge that enriches our understanding of intellectual property accounting complexity in the global streaming landscape. We'll now introduce ourselves.
Hi, I'm Kayla Lee. I'm the team captain. I have a bachelor's degree in business administration with a concentration in accounting from the University of California, Riverside. After this program, I plan to work at ConResnick in San Diego in the assurance field.
Hi, my name is Shalini Pillai. I'm the team conference speaker. I have an extensive background in accounting, given my bachelor's in commerce, specializing in accounting and finance, and my chartered accountancy education from India. I'm currently working towards getting my CPA license and will be joining GPW CPA's post-graduation in San Diego as a tax associate. Thank you.
Hello, my name is Xiaowu. I'm the team research analyst. I hold my bachelor's degree in accounting from Wenzhou King University, and after graduation, I plan to work as an auditor at EY in San Francisco office.
I'm Shu Yuan, and I'm our social media manager. I hold my bachelor degree in accounting from Xiamen University, and after this program, I will work as a fund accountant in a financial company in Carlsbad.
Hi everyone, I'm Zhichen, and I graduated from Baylor University, majoring in accounting and supply chain management. And after graduation, I plan to become an auditor.
Hi everyone, my name is Matthew Vokel, and I hold a bachelor's degree in accounting from San Diego State University. I'm currently working as a federal defense contract accountant for the Department of Defense, and I plan to continue this role after graduation.
Hi, my name is Wang He. I am team logistics and technology specialized. I hold a dual bachelor's degree in accounting and hospitality business from the Michigan State University. I plan to become a corporate accounting. Thank you.
Thank you, everyone. Now let me establish why content as capital demands immediate board-level attention. In the streaming industry, intellectual property isn't merely an asset. It's a core capital that defines competitive positioning, drives subscriber acquisition, and determines long-term viability. Unlike traditional tangible assets with established valuation methodologies, streaming IP presents unique challenges. It's intangible, culturally sensitive, and subject to rapid market shifts. The fundamental issue is that traditional accounting methods were designed for physical assets, not for content that can become globally viral overnight or lose relevance just as quickly. This mismatch between valuation approaches and asset reality creates significant risks for misstatement, investor misleading, and strategic misallocation of resources. Accurate IP accounting isn't just about compliance. It's about ensuring transparency, preventing manipulation, and reflecting true economic value in a rapidly evolving digital content landscape where billions of dollars in capital allocation depend on these assessments. With that foundation in place, I'll now hand over to Kayla, who will now explain why intellectual property oversight is becoming increasingly urgent in today's media landscape.
The urgency of this topic is demonstrated by a growing body of evidence showing that inadequate IP accounting is exposing media companies to material risk, and boards are responding with increased scrutiny. First, we've witnessed significant market shocks from real-world losses. Warner Bros. Discovery $9 billion write-down in TV content in 2022 exemplifies how impairment losses tied to outdated valuation methods and declining legacy media revenues can devastate shareholder value. Second, regulatory pressure is intensifying. The SEC has become increasingly specific in its scrutiny, as evidenced in Netflix's 2024 10-K filing, where capitalization, amortization, and impairment rules face enhanced examination, with particular emphasis on transparency for both licensed and original content. Third, industry leaders are acknowledging the complexity. Major consulting firms, PwC, EY, and others, are publishing comprehensive guidance on royalty-based risk in IP licensing, and the complexities of ASC 606 bundled IP revenue recognition, calling for updated models, stronger controls, and new board-level policies. Finally, academic perspectives confirm that models are still evolving. Recent case studies on Netflix's IP amortization highlight the lack of global consensus and the need for evolving best practices in this space. To help us navigate the big picture questions that boards must confront, I'll pass it to Warner.
Now we will move to key question for board oversight of IP. Today's session is not about textbook theory, it's about boardroom reality. As we all know, streaming platforms today are built on intellectual property, whether it's content libraries, recommendation algorithm, or brand equity. IP isn't just an asset, it's a business model, and yet, as economic involve factors than our standards, we face a pressing question: how do we value and govern IP in a world where the rails are still catching up? The challenge is not just technique, it's strategic. It's about a unified valuation framework. Companies, even the most sophisticated ones, are exposed to real risk. Models become inconstant, assumptions become subjective, and suddenly earth declarations, even involved trust, all start to erode. Both are at the center of this tension because our job is not just to ensure compliance, it's to ensure judgment is exercised with rigor, transparency, and integrity. Too much flexibility can involve manipulation, but too much rigidity. It can stifle value innovation that drives growth. The wise decision is structured around 5 essential questions. These questions didn't come from a textbook, they came from real ballroom discussion, financial feelings, and governance dilemmas. This development leads us to 5 fundamental questions that every board must address. Why does it matter? IP is the core of streaming-driven growth, engagement, and competitive edge. It is often misvalued or overlooked, putting strategic decisions at risk. What can go wrong? IP employment can hit earns, erode market value, and damage investor trust. Both need to understand the struggles and how employment is tested. How is it recognized? Accounting treatment depends on how IP is acquired. Standards like ASC 350, 805, and 926 guide variation and employment, and mistake can lead to complex issues. How do we protect it? Valuation model needs strong control. Inputs like watch time on stream must be backed by reliable systems. Weak controls can lead to major financial reporting risks. How do we govern it? Both must ensure transparency, constance, and audit oversight. Governance builds trust not just with regulators but with the market. Each of these questions forms a building block. Together, they provide a practice framework for how both can navigate IP governance in the stream era with clarity, confidence, and credibility. Now that we laid out the key question, Kira will walk us through the definition and scope of IP in this context.
Let's establish our definitional framework. Intellectual property represents property created by the mind, original ideas, expressions, inventions, and designs that have real economic value and encompass various forms of legal protection. Copyright protects creative authorship, the foundation of streaming content. Patents protect inventions, including the technological innovations that enable content delivery. Trademarks protect brand elements, slogans, logos, symbols, and names that build platform identity. Trade secrets encompass proprietary formulas, practices, and processes that create competitive advantage. In streaming, these categories often overlap and interact, creating complex valuation challenges that traditional accounting frameworks struggle to address comprehensively. Each form of IP plays a distinct role in creating value, but that value only holds if the IP is clearly defined, properly protected, and accounted for with discipline. Next slide, please. Our analytical framework focuses on how streaming media companies manage and integrate their intellectual property within their financial architecture. This matters because digital content represents unprecedented scale. We're examining an industry where individual content investments can exceed traditional corporate acquisition values. The implications extend across stakeholder groups. Investors require accurate valuations for capital allocation decisions. Consumers drive the demand signals that determine IP value, and board of directors bear fiduciary responsibility for oversight of these critical assets. To show how IP mismanagement can ripple through an organization, I'll turn it over to Shalini.
Thank you, Kayla. Let's examine why intellectual property has become the cornerstone of streaming business model and why boards must understand this fundamental shift. IP in streaming isn't just content, it's capital. Think of it as an engine that drives 3 critical value dimensions. The first being revenue engine. Every subscription fee, licensing deal, syndication agreement, and merchandising opportunity flows directly from intellectual property rights. Netflix's Stranger Things doesn't just drive viewership, it generates revenue across multiple streams, subscription retention, global licensing deals, and merchandising partnerships. Without intellectual property, there's literally nothing to monetize. Valuation drivers are next. Most market value in media firms today stems from intangibles: content libraries, recommendation algorithms, trademarks, and franchises. When Disney's market cap reflects billions in intellectual property value, or when Netflix trades on multiples tied to content assets, we're seeing intellectual property drive enterprise valuation. Impairing intellectual property means impairing enterprise value directly. Then comes strategic differentiator. Exclusive content defines platform and determines market positioning. Netflix originals differentiated from competitors. Disney Plus franchises create pricing power, and exclusive intellectual property determines merger and acquisition value when companies evaluate acquisition targets. The board takeaway in this: if intellectual property is undervalued, impaired, or mismanaged, the entire business model is at risk. This isn't a supporting asset, it's the foundation. To explain how accounting standards specifically treat IP in streaming, I'll turn it over to Matt.
There are three primary accounting standards that govern IP treatment in streaming media. ASC 350 addresses impairment of intangible assets, providing the framework for testing whether content has lost value and triggering write-downs when performance drops or content no longer meets expectations. ASC 805 governs business combinations, applying when companies acquire content or media rights through transactions, defining how to value IP and record it appropriately on the balance sheet. ASC 926 specifically governs entertainment content accounting, addressing how to treat production costs for films, series, and digital content, explaining when to recognize revenue and how to spread costs over the appropriate periods of time. And now let's expand on how digital real estate is accounted for based on how it's created, acquired, and licensed. ASC 350 applies to internally developed IP, which generally cannot be capitalized, so it's measured at cost with limited recognition on the balance sheet. ASC 805 covers IP acquired through mergers and acquisitions. So if the IP is identifiable, it can be capitalized at fair value at the time of acquisition. And ASC 926 governs produced or licensed media content. If it's eligible, this content can be capitalized and then amortized over time based on the revenue it generates. So the key takeaway for a board is that IP isn't treated uniformly. How it got on the balance sheet shapes how it's valued, tested for impairment, and disclosed. With those standards in mind, Xiaowu will now share how leading companies apply them in real-world scenarios.
Thank you, Matthew. Comparing Netflix and Disney practice reveals different approaches to similar challenges. The first is capitalization. Netflix capitalizes content costs when titles become available for streaming, based on the expectations of future economic benefits such as subscriber growth and retention. For example, Stranger Things Season 4 drove big increases in both global subscriptions and viewing hours, supporting the decision to capitalize rather than expense production costs, while Disney capitalizes both self-produced and acquired content. The second is amortization. Netflix uses a consumption-based amortization model, expensing more of the title's cost early in its life when viewership is highest. Metrics like total watch time, completion rates, and average episode watched guide amortization. For popular shows like Stranger Things, a larger share of the amortization occurs soon after release, while Disney amortizes self-produced content based on projected revenues and uses straight-line amortization for acquired content. And the third is impairment. Netflix tests content for impairment when actual performance falls short of expectations, typically due to low viewership or engagement. Real-time analytics help identify underperforming titles early, as in 2022, when the company canceled shows like Bone and recognized impairment losses. Disney may assess impairment at a broader level, such as by brand or content group, when forecasted revenue decline. Lastly is royalties. Royalties tied to usage or sales are expensed as incurred. Netflix often pays third-party content creators based on actual viewership, aligning costs with performance. These payments are typically settled quarterly, Disney, on the other hand, earns royalties by licensing its IP globally, recognizing revenue over time as performance obligations are met. Next, Shalini will discuss impairment in detail.
Thank you, Shawu. Let's address the fundamental question. What happens when intellectual property loses value, and why do impairments hit so hard? While IP is mismanaged, the consequences cascade across four critical dimensions that every board must understand. The first being direct financial impact. Write-downs reduce net income and earnings per share immediately, but they also increase volatility in reported financials, especially under ASC 350 and 926. We're not talking about minor adjustments. We're seeing billion-dollar write-downs that signal systematic failures in forecasting and strategic planning. Then comes valuation and market confidence. Repeated impairments erode investor trust, and stock prices react sharply. Warner Bros. Discovery's $9 billion content impairment demonstrates how these adjustments destroy shareholder value. Investors begin questioning whether content assets are properly valued, creating a crisis of confidence that extends beyond individual impairments. Then we come to strategic fallout. Intellectual property impairments force complete reevaluation of content strategy and capital allocation. They limit future merger and acquisition leverage and partnership negotiations because they signal flawed assumptions about content performance, market demand, or competitive positioning. Then we come to governance and audit risks. Poor impairment testing and inadequate controls may trigger material weaknesses. The SEC examines whether companies have adequate controls, whether impairment triggers are identified timely, and PCAOB scrutiny is increasing, especially around content-related judgments. The board takeaway in this? Intellectual property impairments aren't just accounting adjustments. They're signals of strategic failure and governance breakdown. The frequency reveals that traditional accounting frameworks struggle with assets whose value can shift dramatically based on cultural trends and market dynamics. Boards face multifaceted decision-making across four critical dimensions that require sophisticated governance. The first being strategic considerations. Intellectual property portfolio valuation serves as a primary driver of overall company valuation. Boards must evaluate make versus buy decisions for content development versus licensing and assess competitive positioning through exclusive IP rights acquisition. These aren't operational decisions. They're strategic choices that define competitive advantage. Then we come to financial considerations. Capital allocation between content creation and technological infrastructure requires careful balance. Boards must understand the impact of intellectual property accounting treatment on financial reporting accuracy and oversee forecasting of content amortization timelines that align with economic reality rather than accounting convenience. Next is ethical considerations. Ensuring fair compensation to creators and right holders while maintaining transparency in reporting content performance to stakeholders. This includes honest disclosure about content performance and risks. Next is risk management and compliance. Sophisticated rights management systems prevent unauthorized use, compliance with varying international copyright laws protects global operations, and cybersecurity measures protect valuable intellectual property assets from theft or unauthorized distribution. The board's oversight role includes establishing risk tolerance for content investments, approving major content acquisition deals, and reviewing accounting policy changes that affect intellectual property treatment and valuation. These decisions cascade through the entire organization and determine long-term strategic success. Now, we talk about tools, including valuation models and internal controls to protect the intellectual property value. Protecting intellectual property value requires sophisticated tools across three integrated areas, the first being valuation models. Companies need multiple approaches to capture intellectual property complexity. Discounted cash flow models based on projected content earnings, like watch time monetization, provide the foundation. The relief from royalty method proves useful for intellectual property like trademarks or content libraries with licensing potential. Churn-adjusted lifetime value becomes especially relevant for subscription models in streaming, where content drives retention. Then is internal control frameworks. The COSO framework provides structure for evaluating controls over impairment testing, model inputs, and forecasting. The SOX 404 compliance ensures effectiveness of controls related to intellectual property asset valuation, and failures here can trigger material weaknesses. Audit trail integrity maintains traceability of intellectual property assumptions and valuation decisions, supporting both internal governance and external audit requirements. Then we come to monitoring and triggers. Real-time systems provide automated alerts for viewership drop-offs, underperforming content, or cost overruns. Netflix demonstrates the best practice here. Their systems flag impairment risks when they start developing and not when quarterly earnings are affected. Periodic stress testing of intellectual property valuation assumptions against market trends ensures models remain relevant as conditions change. The sophistication of these tools reflects intellectual property's central role in business strategy. Companies that treat intellectual property valuation as a technical exercise rather than strategic capability expose themselves to the kind of massive write-downs we've seen across this industry. Now that we've looked at the tools and controls involved in protecting intellectual property value, Matt will break down the valuation models that the companies rely on.
Thank you, Shalini. Now we will discuss three primary IP valuation approaches: the income approach, which values IP based on future cash flows, the market approach, which relies on comparable transactions, and the cost approach, which considers replacement or recreation costs. There's no universal standard that fits all situations, and IP value depends significantly on professional judgment and can make a board question the underlying inputs being essential. Companies must use consistent methodologies and clearly explain their valuation approaches across different content types. Key inputs include projected cash flows, content longevity assumptions, amortization schedules, viewership metrics, and engagement data. Critical to this process is establishing robust monitoring and oversight mechanisms. Board oversight requires comparing actual performance data, such as viewership numbers, revenue generation, against the assumptions that underlie IP evaluations. When performance drops below expectations, this may signal the need for impairment testing under ASC 350. In the most sophisticated companies implement real-time monitoring systems that automatically track content performance against initial projections. These systems create early warning indicators that trigger reassessment before write-downs become necessary, representing a shift from reactive impairment recognition to proactive value protection. And next, Warner will take us through common valuation models.
Thank you, Matt. The income approach most commonly used in streaming values IP based on discount future cash flows. Incorporate inputs like customer lifetime value, churn rates, and listing revenue. This method is widely adopted for subscription service, stream platforms, and production IP tied directly to revenue generation or cost savings. The market approach compares IP to recent sales or lessons of similar assets, such as franchise or music catalogs, but has limited application on less reliable market comparables exercise. The cost approach estimates value based on the cost to recreate or replace the IP, but it's rarely used for subscription models as it fails to reflect true earn potential and market dynamics. Now, to put this valuation model into action, the next slides will take us through real-world examples across different business models. Under the subscription plus rent model, like HBO Max, IP is valued using discounted cash flow. Companies project future cash flow from subscription and leasing, then discount it to present value, key inputs, churn growth, and exclusive content. IP as valued by driving users' retention, acquisition, and pricing. Show like Game of Thrones both revenue and strategic strengths ensures IP valuation reflects both financial return and platform impact. Let's look at how Warner Bros. Discovery values IP under its subscription plus rental model. HBO Max earns from both monthly subscription and leasing deals, streaming for users, and content sold to platforms like Netflix. Accounting-wise, production costs are capitalized and amortized based on expected performance. Leasing income is recognized over each deal's terms. Strategically, Warner Bros. uses DCF model, project revenue from supply chain, global leasing, and future franchise potential, like spin-overs on merchandise. By discounting cash flows for risk, the company captures both the near-term earnings and the long-term strategic value of its IP. Next, Shao will introduce us to other business model.
Thank you, Warner. Netflix, operating under a pure subscription model, derives value from content-driven subscriber growth and retention. They capitalize content costs as content assets, using internal DCF models based on consumption data, such as viewership and churn. Amortization is calculated using expected viewing patterns rather than fixed timeframes, allowing for more precise impairment testing. Next slide, please. Blumhouse Productions, as a franchise-focused production company, leverages original IP across multiple platforms. Their valuation considers total franchise revenue potential, including sequels, streaming deals, and licensing. They capitalize production costs and amortize based on actual and projected revenue. Strategic value includes brand equity and multi-format adaptability. While their models differ, both companies exemplify how IP accounting and evaluation must adapt to strategic models, one focused on subscription value, the other on transmedia franchise expansion. Next, Kayla will discuss the recommendation for standards.
Based on our analysis, we recommend different approaches based on company type. For subscription companies that also produce content, we suggest calculating the average of market-based, cost-based, and income-based approaches to capture multiple value perspectives. For production companies, we recommend a weighted approach, 40% cost-based, 40% income-based, and 20% market-based, recognizing the importance of production costs and revenue potential. For subscription and rental companies producing their own content, we suggest 50% market-based, 30% income-based, and 20% cost-based approaches, emphasizing market validation while maintaining income and cost considerations. We will now move on to Matthew, who will discuss the importance of controls.
Thank you, Kayla. Now let's explore the role of internal control in the governance of content IP evaluation. The COSA framework offers a structured approach for evaluating controls, specifically over impairment testing, valuation model inputs, and forecasting assumptions. These are essential to maintaining consistency and reliability in financial reporting. Under SOX 404, companies are required to prove that these controls are effective. If they're not, it could result in a material weakness which carries regulatory and reputational risk. Finally, audit trail integrity ensures that every assumption used in valuation is traceable. This supports audit readiness and strengthens the credibility of reported IP values, especially as content becomes a more central asset on a company's balance sheet. And now, Zichang will walk us through monitoring accounting systems in the IP landscape.
Thank you, Matthew. Let me put it this way. You can have the best accounting system in the world, but if you're not watching the signals, you're still going to get burned. Monitoring and triggers are your first line of defense. They are your smoke detectors, and it's in the streaming business, smoke spreads fast. Here's what that means in practice. When viewership drops suddenly, and when projects ROI goes sideways, or when costs below past of the budget, those aren't just headache for the operational team. They are potential signs that an asset is losing value and fast. That's where automatic alerts come in. If your systems are set up right, you don't wait for the month end close to see the problem. You know the problem the moment it happens. But automation isn't magic. You still need brains behind the buttons. And that's where periodic stress testing makes a real difference. Thinking of like this, you're flying a plane in changing weather. Your valuation assumptions are your flight plan, but the sky keeps changing. So you benchmark those assumptions against market trends, consumer behavior, and competitive content moves. So if your strategy is flying blind, the board needs to step in and ask, Are we updating fast enough? Are we comparing ourselves to what's actually happening out there? And when the warning light flash, are we reacting or just watching? Because here's the truth. Internal controls are not set it and forget it. They are a living system. They have to evolve as the business evolves. So if you ignore the fire alarms, don't be surprised when there's smoke in the financials. Now I will pass it to Shuyan to cover governance and disclosure.
Now let's take a look at how can boards build trust through oversights. Boards are the last line of defense when it comes to how intellectual property is reported and protected. This includes reviewing capitalization policies, amortization schedules, and identifying impairment triggers. These are not just technical details, they shape how assets are valued and perceived externally. It's also critical that these policies stay aligned with SEC guidance and PCAOB expectations. Regulatory alignment isn't optional, it's a foundation for investor confidence. Beyond policy oversight, internal control can equally essential. Audit committees must actively oversee causal-based controls to validate impairment testing, modeling, and forecasting. Monitoring SOX 404 attestation is a key step to identifying and addressing any martial weaknesses related to IP. Next slide, please. Building on that foundation, we now turn to disclosure transparency and stakeholder trust. Clear and honest disclosure are what translate technical process into actionable insights for investors. They must clearly describe valuation methods and amortization assumptions and signal early impairment indicators like drops in viewership or customer churn. It's also important that MD&A narratives reflect real financial risks. When there's an alignment between the story a company tells and the data behind it, trust grows, and that trust is essential. Timely and accurate disclosure helps build investor confidence, while proactive broad engagement reduces the risk of regulatory surprises. And at last, financial integrity, brand reputation, and market confidence all depend on how effectively IP governance is carried out and communicated. Next slide. So to quickly recap, intellectual property accounting is now at the heart of strategic decision-making for streaming companies. As we have discussed, understanding the standards is essential, not just for compliance, but for protecting valuation, reputation, and stakeholder trust. Boards must take an active role, ensuring robust IP accounting policies, overseeing impairment and valuation process, and integrating IP governance into broader risk and investment strategies. Besides, we talked about how the companies do the valuation and give our recommendations for standards based on different companies. Our team hopes that this session helped to highlight why IP accounting is not just a technical issue, but a strategic opportunity for responsible leadership in today's fast-changing medium. And lastly, Zhicheng will close out our recommendations with a focus on internal controls and board-level oversight and practices.
Thank you, Shuyan. So what did we really learn from all of this? After looking at how companies like Netflix and Disney tackled IP accounting, one thing is clear. This isn't just about following rules. It's about building systems that think ahead, act fast, and communicate clearly. So let's break this down. First, let's be honest, accounting rules means nothing without real enforcement. So yes, review your policies on content cost, capitalization, amortization, but that's the easy part. What matters more is embedding control that do the job. You need systems that catch impairment risk when they start smartening, not when your quarterly earnings are in the flames. Netflix show us how it's done. Their accounting system pull live viewer data, like watch time, completion rate, trends. If a show start underperforming, boom, it flag instantly. No delay, no excuses. They don't wait for the bad news to explode. They intercept it mid-air. That's not just accounting, that's intelligence. And here's the real kicker. Those alerts are automatic. Real-time dashboard track performance against valuation assumptions. So if a show drop below a certain threshold, everybody knows. Accounting, finance, marketing, one team, one red flag. Now let's talk about discipline. You can't just throw money at content and hope it sticks. Hope is not a strategy. You need the rules, hard lines, predefined benchmarks. So before you greenlight anything, whether it's a Marvel blockbuster or reality show reboot, you should ask, what does success look like? And if we don't see it, when do we walk away? And Disney nails this. They set a revenue target and a viewership benchmark for each title. So if a show under delivers, it gets reviewed for impairment early. But they don't just stop there. They coordinate with auditors. They validate assumptions. They test their model quarterly. So smart investment means knowing when to double down and when to cut your losses. You don't ride a failing project into the ground. You write it down and move on. And here's the final piece, transparency, because investors don't just want to see the numbers, they want to understand the why. When does impairment happen? What triggers it? How is value determined? Netflix get this right in its MD&A. They disclose specific impairment indicators like completion drop-offs, revenue shortfalls, or cancellations. They connect the dots between performance and accounting. But great companies go further. They build reporting pipelines. They gave boards quarterly reports with IP performance matrix, sensitivity analysis, and early warnings. That's next level governance. And best price hurts trust and hurts the stock prices. But when you are upfront, even tough news became manageable. So let's be clear. Review your policies, build real-time controls, set hard rules, and tell the story, honest and early. Because in this business, clarity isn't just good practice, it's survival. So how should board respond to the risk and opportunities of intellectual property in the streaming? First, we need to reframe IP as strategic capital. It's not just content, it's asset, just like factory or cash, and it deserves board level attention. Second, board need to understand the accounting landscapes. Standard like ASC 350, 805, or 926 aren't just technical details. They directly shape how we recognize and test for impairments. Directors should be asking, how are these standards being applied across our IP, whether it's developed, acquired, or licensed? Third, internal controls need to be stronger and smarter. That means reviewing your coastal and SOX compliance, but also making sure we can catch early warning signs like decline engagement or shifting amortization patterns. Fourth, we need a clear oversight policies. That includes setting threshold for content investment decisions and impairment reviews, and then making sure the audit committee and the strategy team are aligned. And finally, transparency matters. Boards should demand clear MD&A disclosures on content strategy, performance matrix, and evaluation assumptions, because investors can't trust what they cannot see. And with all that, thank you for your attention.
Wonderful. Thank you so much, Shishan and team. That was great. Thank you for all the insights, for highlighting such a crucial area of board oversight and financial risk, right? Like really understanding how to manage IP in the current streaming media industry is such a challenge for the board overall. So thank you so much for your thoughtful approach to valuation to this topic and also helping us having a better understanding of audit implication in IP heavy industries such as media. So thank you so much. Thank you everyone that joined the session. So the session replay will be available soon on Ready's YouTube channel. And if you're interested to have a copy, let us know. We're very happy to share with you the copy of this presentation. So our Capstone office is happy to share those with you. So on behalf of the Ready School of Management, thank you for your excellent work, team, and contribution to the 2025 MPAc Capstone. Thanks everyone that participated to this conference. Have a great day.